Hello guys, so on to the next topic. We are going to look at currency pairs closely. Okay, so you already understand that in foreign exchange, we trade paired currency. So we have a base currency and a core currency, so one to the left and one to the right. Example would be USD JP, where that's the United States dollar and the Japanese yen, right? The Australian dollar is now paired with Canadian dollar, so we now have like AUD card, CAD. Okay, so now let's go into them, the different types of currencies that are available, and trading opportunities or decisions on which you should trade, and why you should trade which. Okay, so first off, we'll consider the most traded currencies worldwide. The way we have these statistics is due to how they are being used, the exchanges that are done through them, how stable their economy is, the number of investors that are going to those countries or to those zones, to invest, right? And then how they are performing generally worldwide. Okay, and then we relate that with the foreign exchange market as well. So from that we can see that these are the currencies. We have 8 currencies here. Okay, United States dollar, the euro, being used in the eurozone, all the countries in that area. We have the Australian dollar, we have the Japanese yen for Japan, we have the Canadian dollar for Canada, we have the Swiss franc for Switzerland, we have the Great British pound for the United Kingdom, and the New Zealand dollar for New Zealand, basically. So the only pair that has just been added, or the only currency that has just been added here recently due to how well they have performed in the past decade, is the Japanese yen. Initially it just used to be 7, but then the JPY has performed really well, so it's now a part of this currency. So the major pairs, right, are USD. When USD is being paired with some currencies from the most traded currencies we just treated right now. An example would be Euro USD, and once you bring this to foreign exchange, this is the most traded currency pair worldwide. It accounts for over 20% of the trades that we take daily, or that is being filled into the foreign exchange market daily. Okay, and then a close follow-up is the USD JPY, and then GBP USD, and then USD CHF. These are the most traded currency pairs worldwide. So I was saying, investors prefer to invest their money in countries, in currencies that they believe are stable, and then they understand every single factor that can affect that particular currency. Okay, so the currencies that we listed here, the most traded currencies here, are really stable currencies, so you'd have a lot of investors investing in them. And then USD on its own, that this is the reason why USD is crossed with the 4 pairs that are considered the major pairs here, that are the most traded pairs in the foreign exchange market. But then US dollar accounts for more than 80% of the transactions worldwide on a daily basis. So that explains why USD is here. Okay, and then we have you might ask some people what are the major pairs, and then you'd have them list out 7 pairs to you. The other pairs that they add for you there are the commodity pairs. So the major pairs basically are free floating pairs that are affected by supply and demand. So other than that, the only thing that affects major pairs would be the effect of the central banks. Okay, so the central banks might step in to control the situations of the currencies of their countries, right, to make sure that it is not going worse than it currently is, or to stabilize it. And they might look for ways, either by printing money to control deflation, and then maybe invest in other currencies, or whatever measure they can to control their currency, they do that. So those are the only things that can affect the major pairs. Other than that, it's just strictly supply and demand. Okay, and that will now determine which is weaker or stronger than the other one. Okay, but then when we come to the commodity pairs, these countries have a whole lot of commodities in them, and then investors that look to invest in commodities are really the ones that go to invest in commodity pairs like this. So example is USD and the Canadian dollar, AUD USD, right, the New Zealand dollar and the USD. These are the 3 examples that you have here. Okay, yeah, so the minor or cross currency pairs. Okay, the minor or cross currency pairs is the result of crossing any of these most traded currencies worldwide, okay, without the USD. Okay, so you can see clearly here that it excludes the USD. So an example would be Euro GBP, Euro CHF, Euro, Canadian dollar, Great British pound paired with JPY, CHF, JPY, you know. It could really be any of these things. It could be GBP, CAD, AUD, NZD. It could be any of these things, as long as you cross them and you do not have the USD. And then that's an example of what a minor or cross currency pair. Okay, so on to the next one, exotic pairs. Exotic pairs, you know, we listed a couple of currencies that we have, and then we did not talk about this set of pairs. Exotic pairs basically, you know, are the other country currencies that we have. These countries do not really have a strong economy. It's arguable, you know, because some of them, like Sweden or Norway, you know, have a good economy, but then you cannot compare them to the economy of the other currencies we talked about for the most traded currencies worldwide. Okay, so this is why they are listed among exotic pairs. Okay, and then once you start trading, you understand that they have, you know, really what do they call it? They have really high spreads, you know, when you are trading this. Okay, so you understand spreads shortly, but then they really have high spreads when you are trading this, and then they are really affected by economic factors and political factors, so they can go in one direction for a long time. So now you understand when to buy and when to sell. So that means that if one of them gets weak, it might stay like that for weeks and months, and will just go in one direction for a long time. So people really use them for swing targets. Remember that swing traders are people that take trades and allow them to run for a long time, maybe weeks, maybe months, right? These are the perfect, you know, examples, or these are the perfect currency pairs to trade, you know, when you are looking for long-term targets. And it's not okay, you know, to trade an exotic currency against an exotic currency, because you are basically just trading two weak currencies. Most brokers do not even quote that for you. Okay, but then it's best to trade them against strong currencies. An example would be, you know, the TRY, Turkish lira, you know, trading it against the United States dollar, or maybe the Norwegian krone, you know, trading it against the euro. Another would be, you know, the South African rand, you know, trading it against the United States dollar. So that means that the United States dollar is the stronger currency, right, compared to the South African rand. But then once you make the exchange, if something eventually happens, it's going to go in one direction for a long time, certainly. Okay, because one currency is stronger than the other currency. You know, if the South African rand gets strength, right, whatever was the catalyst, you know, whatever was the factor that made it have that strength, will continue for some time. Okay, so that means that there is room for you to make profit for a longer time. Okay, so that is just the difference between the exotic pairs and the major currency pairs. So let's move on to the next lesson, guys.